Basel III is an agenda that is very much at the top of the minds of bank CEOs around the world. We're very pleased to be able to speak today with José María Roldán, the Director General of Banking Regulation at the Bank of Spain, but perhaps equally important, a member of the Basel Committee for Banking Supervision and the head of the Standards Implementation Group at the BIS, the Bank for International Settlement. Give us a sense of what you think Basel III is really designed to deal with.
Basel III very clearly is a continuation of the efforts that were started with Basel II. We want to have a regulatory system for the banking sector that is sensitive to risk. The higher the risk, the higher the capital that firms should hold. This was the idea lying behind Basel II, and this is continuing in Basel III, but with an upgraded concept, in the sense that with Basel III, we are going to maintain this differentiation among risk, but we want to have higher capital cushions, if you want to describe them like that, and higher quality of capital. By higher quality of capital, I refer to basically common shares, equity, and reserves. What we have learned during the crisis is that hybrid capital instruments, be it preferred shares or subordinated debt, didn't work as they were intended in terms of absorbing losses of firms and allowing banks to continue doing business in the case of preferred shares. So now what we are doing is kind of back to basics in terms of what capital we want to accept in regulation. We are going to the best quality of capital that is possible. So it is like Basel II with higher capital, higher quality of capital. In terms of the areas, of the specific areas where we have also upgraded Basel II, I would highlight two: the trading book and the securitization scheme. We have seen, as an experience of the crisis, that the capital that was devoted to those areas was not enough. What we are doing is asking more capital to be in line with the risks that have been manifested during the crisis.
In one sense, can we view Basel III as an overreaction? You just mentioned that to deal with the risk on the trading book and securitization, and really the culprits in that space were the investment banks rather than the traditional commercial banks. And it would come across that you're actually trying to apply the same rules across all different types of institutions, when actually the trading book of a commercial bank may not be as significant as that of an investment bank.
I think that what we are trying to do with Basel III is treat same risks equally, independently of the type of institutions we are talking about. I think that is commendable. I don't see Basel III as an overreaction on the part of regulators. It's a reaction to the crisis. Let's not deny that. It's a reaction to the crisis. Is it an overreaction? No, I don't think so. And I think that going forward, it's important for all type of financial institutions to be on safer grounds. This crisis has shown us how hard the crisis can hit in a global financial system, and that can affect complex institutions doing very complex trading activity, but also not so complex institutions that are in this international financial system. If you are a bank that is active in these areas, you are going to be hit harder than a bank that is not active in these areas, for instance, a retail bank. But both of them need to have a capital that is upgraded so that we can resist this crisis, if it happens in the future, can be resisted by the financial sector.
Let me just go one step back. Basel II, the criticism on Basel II during the global economic crisis was that it sort of fed into pro-cyclicality. Just when banks needed capital, they weren't able to secure capital in the economy as a whole. And it didn't really resolve the issue of liquidity. Now, to what extent does Basel II deal with these two elements and take it as a continuation from Basel III deal with the elements and take it as a continuation of Basel II?
Procyclicality is going to be a challenge with Basel III as it was with Basel II. What we have designed in Basel III is a series of capital buffers that will try to limit procyclicality. The first is the capital conservation buffer, that you will have a situation whereby excesses, of risk-weighted assets that create increases in capital requirements will be dealt with limitation to dividends policies as a way to force banks to rebuild their buffer of capital. And on the upswing, for bubbles, we have the countercyclical capital buffer, which is designed specifically to deal with the emergence of potential bubbles coming from the credit markets. So in terms of procyclicality, it's still a challenge. Let's recognize that. Any measure of capital that is based on risk-weighted assets, on risk, is going to be procyclical. But in Basel III, as a difference to Basel II, we are incorporating that procyclicality in the system, and we are building several, let's say, protective walls to deal with the issue of procyclicality. The same can be said on the issue of liquidity. On liquidity, we are devising two types of measures: liquidity coverage ratio, which is short-term liquidity buffer, and the net stable funding ratio, which is in the end, a balance of the asset liability maturity mismatch that banks could have. Let me also add, because this is to recognize reality, that whilst in the area of capital we had a lot of experience, we have Basel I, we have Basel II, we know what went wrong with each of those, and now we have Basel III. We are kind of building over something that was existing. In the case of liquidity, we never regulated liquidity. So we are faced with special challenges when we are designing these new measures. That's why the Basel Committee has been very clear that in case that these liquidity regulations create unintended consequences, we are ready to go back to the drawing table and to see what can be done.
Is that part of the reason why the Basel III implementation roadmap is so long? Is it to absorb some of these learning processes in place?
Yes, to some extent is to absorb these novelties and be able to deal with them in a safer ground. Can be applied to liquidity, but also to the leverage ratio. And also, to some extent, is the message that this is a very high standard. I mean, when people say whether Basel III is not really tough, I mean, Basel III is enormously tough. And it's a step in the direction of having tougher regulation. But because this is not about dealing with the last crisis, this is about dealing with a potential future crisis, you should not rush to apply this new regulation. This new regulation is not to solve the crisis that we are seeing. This new regulation is to prevent the next crisis that will occur for sure in whatever the time frame.
So tell me, in the BIS, in the deliberations in the BIS, where's the focus of the conversations? I'm sure you talk a lot about stress testing, liquidity requirements and so on. But do you stress test the impact of the capital requirements this is going to have on the economy as a whole, and the ability of different types of economies to sustain a banking system which has to meet a Basel III regime?
I think that this type of analysis was done during the design of Basel III. We have done our own analysis.
And you're happy with that? I mean,
and we are happy with that. I mean, I think that we have had a very difficult dialogue with the industry. The industry was pointing out that they thought that Basel III was going to create enormous problems. We thought that Basel III was going to create an impact on lower return on equity, probably lower availability of credit, but that A, this was not going to be massive, and B, this was needed to have, a safer financial system that would prevent the boom and bust type of behavior we have seen in the last crisis.
But that's not what the banks are saying. The IIF, for example, is putting out papers, and various banking associations around the world are putting out papers pointing out, firstly, it's going to increase the cost of business. Secondly, Basel III is far more intrusive than Basel II. In businesses that were not previously or did not previously have capital requirements like trade finance and transaction banking. And thirdly, it doesn't really solve the issue of procyclicality and liquidity as we were discussing.
Yeah, our analyses are different.
Are you at odds with the banking industry?
Yeah, but let me be very clear. I mean, our analysis was different, but we are not in the stage of discussing with industry anymore. Basel III is a reality. It has been approved by the Basel Committee. It has been supported by the G20. Basel III is going to be a reality. So my message there is that stop quarreling about whether Basel III is a good idea or not. Basel III is going to happen as the sun is going to rise tomorrow.
Okay.
So you better prepare for impact as an industry rather than continue discussing the pros and cons of Basel III. Different is the area of liquidity I was mentioning. Here, I mean, we have some prevention and we are ready to return to the issue if there are unintended consequences. But generally speaking, on other aspects of Basel III, my message to the industry is pass the page of the book, move forward. I mean, there's no way we are going to go back and delete Basel III. Basel III is a reality and you should incorporate that reality in your business planning.